I'm going to go through the PowerPoint like I did last time. I'm recording this and will make the link for these recordings available to you. And that I was last time took me a couple days to figure out how to do that properly with Mondo Man, but he helped me get that sorted out. So we'll be going over financing, basically the two main parts or two different sides of a partnership for the financing, and then what both of those parts of the partnership should be doing and what they need to know. So let's get right into it. Okay. So with financing and with funding a deal, you really have two main parts, two groups, I guess, and that's the person bringing the funding, as well as the person developing the project. Okay, now a lot of you are the developers of the projects, where you found the deal, you found the property or the grow, and the license, and you've put together this deal. You've got it under contract, or you have built the business plan behind it, and have all the operations, and you plan to manage the actual growing aspect, going from seed all the way to the sale of the product. And then you have the side of the partnership, be it another student, or a bank, or a lending institution, that is the funding side. Ideally, if you have the money yourself, you can get it up and started without anybody else being involved. But this is the most common scenario, is having one or the other. And if you have the funds available to invest in a grow, to be the funding part of the partnership, it's still a very active role, and depending on how you decide to work with each other, it can be a very active role. But there are different things that you're going to be focusing on. So I'm going to go through both of those, and then a lot of what I'll talk about is actually focused on what financing groups are looking for when they look at your deal, your business plan, and the business history of the grow that you're wanting to invest in, or wanting them to lend their money for. Okay. And so we have the funding side of it. That is the person who is bringing capital to the deal, and the things that you need to be focused on, the parts of the partnership that you bring to the table, the asset that you bring to the table, is raising capital so that is readily available. Okay, and this is really the main goal and main job of the person bringing capital to the partnership, is making sure that when you do need to pay or bring the money to closing, when you need to send in the earnest money, etc., that you have those funds available, and you make that part of the transaction smooth. So if you have assets that are tied up in a non-cash form, non-liquid capital form, then you need to either get it liquid, or know the steps to do that as quickly as possible, and have an idea of how long it would take. If you have your assets tied up in merchandise from a different business, etc., you need to know about how long it will take to liquidate that and turn it into usable cash. or if you have cryptocurrency or something like that, stock funds, how quickly you can liquidate that and make it available. Um, if everybody follows that, just for participant acknowledgement, just hit a money sign in the chat, so I know that you guys are hearing me. You're also wanting to maintain a high credit score, and sometimes that's not that's the majority part of what you need. Okay, and sometimes you have people that have put together this deal, but they just don't have the credit score that it would take to qualify for any type of financing. And there's a bunch of different types of financing, and some of those are the no capital down or no collateral needed. And so that is very much an option, a viable option. If you have capital, if you have collateral to back it, then that's going to make the application for financing easier. You will have an easier time with getting a good rate and a larger dollar amount that an institution would be willing to lend to you. And so keeping that credit score high is sort of part of your job in that role of being the funder. Then going out and applying to finance institutions, places like Diamond Finance Services, 420 properties will, and their 420 lending will actually connect you with different lending platforms. There is Canna Business Resources is another one for people in New Mexico. All these different cannabis-based or cannabis funding finance groups. This is really the person that's bringing the capital. Let's say, if you have the finances to fully fund it, you could do that. But I am always a fan of being able to leverage someone else's money. And in this case, it's the financing institution or the bank institution. If you were to just be going for a real estate loan or something like that. And to find effective ways to try to find the most effective way to raise the capital and make it as profitable as you can. If you are able to take that capital and fund two different deals, then why wouldn't you? So when you're looking at the capital that's available to you, and this is sort of also for the people that are doing the development, you have to be thinking in terms of what the people that are funding are thinking. And so, that is a big part of that too, is understanding what your partner is supposed to be doing, is thinking about. And then there is the coordinating the information with the developer part of the partnership for all the relevant financing information. And we'll get into this at the end of the PowerPoint of what kind of information do you need to provide for the financing groups? What are they going to be asking for? What kind of questions should you be ready for, and have your information in order? Okay. If that all makes sense, type in funding in the chat. And recently, we sent out an email sort of directing people that are looking to be the funding part of the partnership to contact me. And I've got several Leafy Learning students that have contacted me, and now I'm working with them to try to connect them with the people that have deals that are ready to go and funding. So I want to make sure that everybody is understanding that, and for anybody that's listening, if you are looking to be the funding side of the partnership, then you can reach out to me at thor@teamarmando.com, and I can help you find a match with another Leafy Learning student to partner in a grow. Okay. Oops. Now we go to the developing side. All right. This is the person that is going to be finding and setting up and executing the deal. So putting all the pieces in place. You've found a property. You've found a grow. A good opportunity. You're finding something that is profitable. You're contracting and making sure that deal is a good deal in regards to its the purchase price, the amount of renovations that you need to get it up and operational, and then how much operating costs it's going to take you to get to your first harvest where you start bringing in the money. And then make sure that money coming in is a good return on the investment for the person funding. That is the piece that you bring. And so the better deal that you're able to lock in when you get a property or a grow under contract, the easier it is going to be for you to find the person that's going to want to help fund that deal. So that acquisition phase is really important. And so you're going to have to take a little bit of time to come up with theory craft the scenario. If you're going to have X amount of space, then how many plants can you get into that space? What is the poundage that you're going to be able to produce? And so your indoor production equation is going to be important for you to know your numbers and know what you're getting into, as well as when you're searching for these properties on something like Canna MLS or 420 Properties, something like that. There's a lot of good properties that I have seen, potentials, and analyzing those properties the way that we taught you to, and verifying that what is in the listing, what is in the pictures, is what you're looking at. Doing a site visit and confirming that the facility is in as good of a shape as they present it, because they will present the best. And so that's really the legwork that the developer side of the partnership brings to the table, and the value that you're providing to the person that wants to fund the grow. It's always important to understand where your value is, so that you do it really well. And then when you go and negotiate to set up a partnership, that you understand how valuable your part is compared to the capital side of things. The person bringing the capital, that makes pretty straightforward sense as the value that they are bringing. This part is also very valuable. And then building the growing team. So this is the growers, your company, the accountants for your business, any attorneys that you need to use in the process for making sure that the licensing is up to date, any permits that you need for operations, and also your bookkeepers, and making sure that you have a system in place, or a plan for the office management of your business. This is something that is extremely important in starting a business, to make sure that you're well organized. And then if you have that plan in place, or if you have the people that are going to be working with you in that regards, it may be yourself, it may be somebody that you're contracting it out to, but having that plan available is going to be extremely important and beneficial to you for showing that you have your ducks in a row, that you've put the time and effort into creating this functional system. And these are all things that you can be doing in the time between finding the deal and having it under contract and closing on the property, and being able to put these building blocks together. And then lastly is communicate all that relevant information, which we're about to go over, with the funder for their financing, and also for negotiating the partnership of the terms. So we'll talk about this just briefly at the end about, your wanting to have a partnership of some kind, but that's still very well open to the negotiations. Some people that have done the development, they found the deal, etc., they've started up the company, they may not want to offer a portion of the company to your funding partner. You may just want to offer a loan with a rate of return, and then the funder may also have their desires. They might want to be a larger part of the grow. They might want to be involved in the company. Maybe the funder has some growing experience and would actually bring benefit to the partnership through being more involved. And so there are potentials for how to work with each other that really run the gamut, and it depends on the two different parties involved, and what their desires are. So, finding somebody that wants to fund a deal and finding somebody that has a deal is the first step. Then matching those people with the right group, the right partners, to match their desired outcomes. Okay. And so those terms, my point is, those terms that you would be willing to accept from somebody else is something that you should be thinking about, and you should have that written down. So and if you have a partner already, you want to discuss that with them to make sure that any other partnership, funding partnership, or the developer partner is amicable for what you want to do with your business. Okay. So that part, it needs to be said. It's generally that relationship is well understood, but it does need to be defined and thought about. Okay. Now, from the financing side of things, and thinking about this from a financing institution, what are they looking for? What are they thinking? How do you get that extra financing to do a deal that is more than the capital you're able to bring yourself? And so they're asking two main questions. Do we want to loan to the company, to you, the grower? And what rate and terms will cover our risk assessment? Okay. And so they first qualify, they have basic qualifications that are telling you whether they want to loan to you at all. It's a yes or a no. If there are some finance groups out there that won't fund or won't loan to Oklahoma businesses, Oklahoma cannabis grows. And I was actually talking to one today that was all about loaning in New Mexico, but didn't want to operate in Oklahoma. So, when you're out looking for different financing options, you may run into that. That's okay. It happens. But you want to make sure that you qualify through their basic stuff. Some have minimum credit scores anything below a 680, and they don't want to lend. Some are 700 and up. You'll need to qualify. They will be qualifying you, and you'll need to know how you would qualify, and that allows you to know whether you need to work on your credit score and improve that, or if you can make it in the door. Then you're talking about the rates and terms, the percentages, and the length of the loan that they're going to be willing to engage in. And this will be affected greatly by your credit score, but also your business plan, your business history. So actually, let's go to a couple of these. The risks, and so let me go through this list. Just type in keep going if you want me to keep rolling, because I'll just keep going full speed ahead if you're all following along. All right. So the risks that a finance group is going to take a look at, your location, okay, and along with that, market viability. So the location of the building, if you're purchasing a building, and this is really in regards to the real estate side of things. If you're purchasing a building, they have to look at it from the worst case scenario and make sure that they're covering that liability. And so if you're not able to pay back the loan for whatever reason, they would then say foreclose on your building. What is that building worth to them? That's going to be based off of its location. So if you have a facility that is way out in the country, that has very few possible buyers, if you were unable to pay back the loan, then that value of that building to the finance firm is going to be lower, because they don't want to get stuck with properties. They are not in the business of holding properties. They're in the business of lending money. And so they will try to liquidate that real estate that they acquire as quickly as they can. So that is a risk factor that they think of. So trying to get as close to a major city or a business district or something like that as possible is good in regards to the financing. It may not be the ideal location for security and for you as growing and having the security of open space and away from a high population, but it still is I would say parallel enough to what you're looking for, because you do want to be close enough to a high traffic, or not high traffic, but a high population for your customer base. You'll want to be around dispensaries that have high volumes, and so that all makes sense. And market viability is really about the different states that you're in, and the different areas, how quickly properties are moving. And to check that, something you can do is just on LoopNet is look for the warehouse space that it mirrors the type of building that you have, and see not just what is listed for sale, but also look at what has sold in the last 90 days or 6 months for commercial buildings, larger buildings, and that will tell you what will be the perceived value from the finance firm, because they will go out and find comparable properties to come up with a valuation. The licensing and permits, they want to make sure if you have an active license, you want to be able to present that to them, because they want to know you can start business right away. If there are any operational permits that you need in your specific municipality, which I realize I just skip local municipality, but that's kind of tied into all this. How favorable that municipality is to cannabis, because not all areas are very welcoming, and so um, if the area is known for making it difficult for cannabis grows, then obviously they will be doing a significant amount of research to find those things out. And you want to make sure that you've done your research on the area as well. Then this is sort of a sticky one for a lot of finance firms, is the business history. And this is how long your business has been in operations. And this is one I've talked through with a handful of people, and often causes a little confusion on how do I, when I'm applying for the finance, how do I state this business history? So, if you're starting up your LLC and your C corp, those are startup companies. They're not going to have a tax return history for these groups to look at. And so going through startup financing, that is understood. But you also want to make known, if you have the information accessible to you from the seller of the business, for example, to get their tax returns. And usually 3 months to 6 months of income statements or last year's tax return, it usually satisfies the amount that they are looking for. If it's over the 100 to 200,000 dollar amount that you're asking to borrow, they usually want a longer history to see. And what you're doing is showing the business that you are buying, showing its business history, and what that business has done up to this point, to give it a better idea of how profitable your business is. Now, every scenario is different, and if you have business experience in cannabis or cannabis related, ancillary businesses that work alongside the cannabis business, if you have any business experience, you want to make sure that that is known, because that does work in your favor, because knowing some part of the cannabis business in a more intimate way will allow you to understand some of the pitfalls that exist in a cannabis run business, and be able to avoid that. So that's all stuff that you would be putting in, say, your business plan. These are all good details to write down for filling out in your business plan. Also, leasing value. So this kind of goes back when we were talking about the location and the property. The value of that property really comes down to the leasing value. And there's cannabis leasing versus traditional. And what a finance group is going to look at is traditional leasing, because you can lease a building to a cannabis company for a much more than you could for a quote traditional business. What would it be renting for if the person is growing microgreens versus cannabis? And because cannabis, there's a spike in value because it's new to the market. It's a whole new market that is emerging. Emerging market was what I was trying to say. There is extra value, and that's why we want to get into this business, and take advantage of that emerging market. Well, eventually and ultimately, that emerging market is going to settle and become more normalized. And these finance groups are thinking the long term. If I'm stuck with this property because the loan wasn't able to be repaid, what am I going to be able to lease it to? And they're not going to go with the optimum top leasing value that you could do for a cannabis grow, they're going to be doing a traditional lease. Then they'll also take a look at assets and equipment valuation, and specifically if they're lending on a business, they won't have, and if you're leasing space from a building, they won't have the real estate as collateral. So if you're doing a collateralized loan, they won't have that building. So they will need to base it off of your equipment. And so that equipment list that you get from the sellers of the businesses is going to be important. And the more detail you can have on that, and the ability to know the resale value of that equipment will help you. And if you are able to have the estimated value of that equipment available and make it a little bit easier for the financing to put it together, and they're going to do their own research in underwriting. They're not going to just trust what you say. They're going to do it themselves. So it's very important that all the things that you're telling them are as accurate as possible. But to be able to provide that and show that you have that in line is a very good thing to have ready for the applications. And to that point about being truthful, and in the underwriting aspect of it, they're going to be doing all the research. They're going to be comparing what you told them versus to what they found out is correct. And you want that to line up as best possible. If they start seeing you're fudging the edges, you're trying to fluff the numbers a little bit, that looks really bad, and that's a fast way to end a business relationship with financing. So you want to make sure, even if it doesn't put your application in the best of light, you want to be truthful about it. And then, so I think I mentioned a little bit earlier the industry and business experience that you already have, important, and then the balance sheet of an existing business to show what it's capable of producing in income. And also your expected, your projected, if you're doing a build out or you're expanding the grow. And then something that a lot of them use as a benchmark is the debt service coverage ratio. And that is the amount of net profit that you, or I should say the profit that you have above the expenses that are going to go into the operation of the business, that income compared to the debt service. So if you're paying on a monthly basis, the payment that you make compared to the income that you have to pay that with. And they want to see a high debt service coverage ratio. And if you can, if you can cover that debt service, and you can cover it by over, if you can have double the income of what the debt service is, then that's a high likelihood that you're going to make all of your payments on time. So that's basically the question that it answers. And so if you can do that, and we can go in a little bit more into the numbers on how to come up with debt service coverage ratio and that type of stuff. If you can have that information for them, then you're talking their language, and that's the important part. So what's a good ratio? So like a rating of like a 1, so 100%. Would be doubling the debt service would be great. Each each firm is going to have sort of their criteria, and it's sort of a conversation that you can have with them of what they're looking for. If you were to call one of these firms ahead of time to get some information to make sure you're putting all your information in the application, that's a conversation you can have with them. But yeah, if you're making bringing in twice what is going out, then you're generally in a good place. And then, yeah, just verify with documentation. So anything that you make a claim about, like your debt service ratio, try to verify it with documentation. And that would be previous income statements, tax returns, etc. And that is, and also permits, licensing. So providing that documentation. They're going to go and pull your company up and see if it is actually registered. But having that stuff ahead of time will make that process a lot easier for them, and they will see that you have been giving them accurate information. And again, a company that is well put together is oftentimes a good bet for them as far as lending their funds out. Okay. Were there any other questions in regards to those risk factors and what and why the finance groups are looking at those? If not, then a thumbs up or keep going in the chat would be great. And I'm gonna go on assuming, yep, we're good, cool. So then there is, those are the two different parts of your partnership, right? The developer and the funder. The funder and the relationship with the financing, or directly from the developer to the financing, and the questions that you need to be answering, the piece of information that they're going to want to know. Now we need to put this partnership together, and I'm not going to go into a lot of depth with this part, but I do want you to at least have an idea of the main possibilities that you can have with setting up a partnership or working with a business, a business-to-business relationship. And when you're lending money for a project. Now you can do ownership of the company, have that partner be a shareholder on your company, or a member, managing member in your LLC. Those types of ownership partnerships, a little bit more like an angel investor setup, where they have a little bit more control, a little bit more say in what happens to the day-to-day operations. Sometimes that can be very beneficial, and especially if we'll say the other party that wants to be wants an ownership portion has experience in the industry, has run a company before, and can give insight into the organization of that company. Sometimes that can work out well. And the percentages that you would give, you want to keep in mind controlling percentages of the company and how much control you're willing to give up, and then what that would represent as far as the profitability, the percentage profit split that represents when you're basically paying out at the end with your net income for that year, and how that works. The other way to do it is not to offer out a percent of your company, but to just write a note, a loan note for the funds that are being offered. And this is really essentially the way that the finance groups that you would work with would be issuing you a note that has a lien. Okay, so the promissory note with the joint venture agreement is essentially the bare bones way of setting it up. And the promissory note is the lien on your asset. So if you own a building and you have a promissory note, then that promissory note is the lender's tool to issue a lien on that property, and if you can't pay that loan back, then the lender is able to foreclose on and use that lien to get their money or their value back. The joint venture agreement goes in and details the way that your partnership works. So if you have a developer who is going to run the grow, who's in charge of finding the grower and the trimmers, that is going to do the day-to-day operations and make sure that business is operating. Those details would be listed out in the joint venture agreement. And if the funding partner is just providing the funds and getting a return, an interest rate, that it would be listed and described in that joint venture agreement. Now, like I said, that's a bare bones lien type setup. The perfected promise or a perfected note would be a mortgage is what it's referred to. And so I believe Oklahoma is a mortgage state and New Mexico is a deed of trust state, and you would be able to put those liens on the real estate if you have it, or you could put that lien on the equipment that the business has. Now, if you're using a finance group, they will have their own lien essentially on some of your assets as in a collateralized loan. And so the second, if the funder is using financing plus their own funds, then oftentimes they would take a second lien holder position, and that's getting a little bit more complicated in the details of it. But I wanted you to at least know the general setup of a contract that you would want to sign with a new partner. And I always want students to have contracts that lay out the details of how those partnerships work. A partnership based off of a handshake, it's just not good enough. You need to have those contracts, and you need to have it spelled out. Having an attorney go through a business attorney go through and help construct those contracts, those joint venture agreements, the notes, mortgages, deed trust, however you structure it, the acquisition of the partnership, that is all important. That's the legal side of things that is important to get done and to have done properly. And so if everybody understands that part, then just type in attorney in the chat. That is where you're growing your power team for your business is going to include an attorney, and utilize that. Is everybody good with that? Okay, so that is it for the the financing. The most important parts of how this system is put together, and how you're going to be working with each other to make the deals happen. And it is a good idea to go and contact, and it will search for as many different finance groups as you can. Um, it can be difficult at first to find lending platforms for cannabis, because there are many restrictions to it, federally wise, but there are companies that will work with you, and will help you fund the deals. And also, you want to keep an open mind as far as the creative options that you can have. So I had mentioned before, some companies, if you have experience or you have another business that's in the cannabis business. If you have an operating business, sometimes those firms can lend based off of that business history. They can lend off of those ancillary businesses that aren't specifically cultivation, aren't specifically this business, but they can set up that financing in a more creative way. Even if you're talking to a group and it turns out they can't help you with the purchase of the acquisition of a business or the purchase of a property, they may be a great option for once you get the property under contract and you need to then set up financing for equipment. Or if you set up your grow and you need to show 3 months of income statements, right? Of bank statement. That's a common request, especially for larger dollar amount investments. Well, if you are able to get a small version of your grow and get it to harvest and show profit, then to get financing to expand to the ultimate size that you want, that is another way that you can go about it. So if you're leasing a property, you're cutting down your initial cost significantly from buying the real estate, the buying the property. And so if you're leasing, you're keeping costs down. If you're able to set up a grow room that is able to produce a moderate amount or even a small amount of product, but you're able to sell it and show profitability, it's able to make an income and a positive income, then that's business history. And that goes a long way to getting the financing to fund the full deal. Now, if it's not ideal. If you have 4,000 square feet that you can grow in, you want to build that out and grow 4,000 square feet grow rooms. But if the financing is the wall that you're running into, if you're able to get, say, one of those 3 or 4 grow rooms you'd be able to fit in that size facility, if you're able to get one up and running, that cost is going to be obviously significantly less. Maybe you would be able to finance that purely with a private investor, get it up and running. And as long as you have a solid credit score, which that gives you time to make sure that the credit score is as good as possible, then you apply for the loan for equipment loans, for startup business loans. 3 months down the road after your first harvest, and then you can use the rest of the year to build out to the size that you ultimately want to get to. And so I want you guys keep those options in the forefront of your mind, and know that they are a real possibility and a way to make it work. I want you to find ways to make this work, and think outside of the box if you have to, but know that there are several tools available to you, and to continue to educate yourself. Contact these finance groups, have conversations with them. Every person that I have called, contact, have been very helpful and very willing to give information. I've just recently went through and did some applications, just to make sure that I was given the best information that I can for you. Now, there's some places. Can you still see my screen with the website? Give me a yes if you do. Okay. And so I have a couple here. That I know are good to look into. Blue Sky Bank. They have no problems working with cannabis, and cannabis business, cannabis banking, setting up cannabis banking with them, as well as lending. So they do business loans, and I'm in communications with some of the people in their loan department, trying to find the best ways for you to actually do the application with them, and at what stage they would be best to work with. You also have Diamond business loans, and these guys, I haven't done a loan with them myself, but from what they're able to offer, and some of the other students that have worked with them, they have a lot of options for you to do, even in the early startup. And you would go to the services provided, business acquisition financing, and start working with them on that. They also have the startup business financing. So that is assuming low or no business history. And then the Canna Business Financing is another one where startup funding and the FICO score based lending, and getting pre-approved for that. It's not going to hit your credit score. You can find out the information through that. And so those are just three that you can check out. I am continually trying to build up a larger and larger list. There's the 420 properties, which actually forwards you on to some other ones as well. Does anybody have other finance groups that they have worked with that have had success or have been helpful? And you can put that in the chat if you want to. But sharing with and staying in contact with other students and seeing what their experience has been is also a good tool of finding the best people to work with for any given time. Yeah, and keep searching. Keep searching, and there's there's always options and always ways to solve the problem, and you just need to keep going at it. And I know it can be tough sometimes, and the financing side, if you've run into a specific roadblock, you don't have an answer for it, it can definitely feel like your wheels are just spinning. But keeping at it and not giving up on that is extremely important, especially in this part. That's starting up a business. There's a lot of frustration, a lot of steps that you got to get going through, and I want to help you as best possible to at least know how to attack this challenge. And like I said, I I want to be connecting the right kind of partners together and finding the people that want to and are able to fund these deals, and keep those the financing options open, in creative ways to make it work. Because you can make a lot happen, even beyond what you think you can. There's so many different ways to go about it. So hopefully that was helpful, guys. And if you have questions beyond this, you can always email me at thor@teamarmando.com. And next week I will be doing another webinar, and we had an issue last week with getting the webinar set up and sent out. I apologize for that. That was partially some of my ignorance with the system I'm working with. But I'll be doing another webinar, and we'll see you guys then, and I'll probably talk to you before that.